Welcome to the 10 Mil Club's standard portfolio video for the second week of May 2026.
From Nashville,
It's the 10 Mil Club. It's the 10 Mil Club.
Nothing in our videos is financial advice. Don't trade solely on anything we say in these videos. Our ownership or interest in any of these securities that we talk about can change at any point in time, and we may or may not own them. Securities that we talk about and present may or may not be suitable for you. You'll have your own ability and willingness to bear risk, and any valuations that we present in any of our videos here at the 10 Mil Club do not show all of our work and will not comply with any of the standards or ethics of any of the valuation societies and organizations to which I am beholden. What is the 10 Mil Club? The 10 Mil Club is an informal group of individuals who believe that if we could get to $10 million of net wealth, we would have the financial security that we so desire. With that, let's go to some market overview stuff. Right now, the market in general does not have good breadth. This is the percent of Standard & Poor's 500 companies that are trading above their 50-day moving average. We're down to about 43.7% right now. That's not great. That means it's not a stock picker's market. And so we sort of shifted gears here at the TMC this past week, and I'll show you that in just a minute how we went about that. We also began to change up our thinking a little bit, and we'll show you that as well. The percent of S&P 500 companies that are above their 200-day moving average continues to move down, still above 50%, about 51.1%, but declining. And you can see the decline here over the past 6 months that we have pulled up. Put-call ratio is generally considered a contrarian indicator. And the interesting thing about the put-call ratio is usually when the put-call ratio is very low, in other words, there are lots of calls to puts, it's a very bullish indicator until it's just not. And it's a little hard to read this particular indicator for breadth and sentiment. But it took a real tick up this past week. Here we are going from high call volume and high call interest to a very quick move into the put direction. There's some things that are bubbling underneath the market that we here at the TMC just don't like. You'll see what happened in our portfolio this week. It was another fairly frustrating week. We're going to have a lot of these. Eventually, we're going to have a situation where we make a lot of money. Right now, we're just not doing it. This is probably the time that Jesse Livermore referred to as the time to go fishing. But it's also the time to do a lot of research. Let's drop in on the VIX just for a second. The VIX, or the Standard & Poor's Volatility Index, isn't up to 20 yet, which is kind of a threshold. It's at 1843. Did take a tick up here later in the week, but as of right now, the market's not showing just extreme concern, but that can move very quickly. The MOVE Index, which is, we have it here right there. The MOVE Index, which is the VIX for bonds, however, moved quite a bit this week. That's a pretty good move in the MOVE Index, or at least the beginning of it, with it breaking a level back here in early May. In general, the smarter money is supposed to be in the bond markets, and that would make the more volatile money, not necessarily the dumb money, but the more volatile money in the equity markets. And a lot of times you'll see a move in the MOVE Index because it involves volatility for bonds before you'll see a move in the VIX. And we did actually see that this week. So let's get to it.
10 Mil Club.
We're still watching Adaptive Biotech, ADPT. I know there are a lot of lines on this chart here. Adaptive, we have this downtrend line here. We're kind of waiting for some sort of a turn. We do have a higher low here, but we're kind of waiting on ADPT. Borg Warner, we here at the TMC we saw this new high, and it seemed like this was unsustainable. This was such a move above its 50-day moving average that we've kind of been waiting for this breakdown. Admittedly, we don't know where a stock is going. Anybody who tells you that he or she knows where a stock is going is really feeding you a line. But as far as we can tell, we would expect a return to more of an uptrend here. Borg Warner returns to that. Now after the post-earnings furor, we'll make our attempt to get into Borg Warner. CARG Gurus, we actually got stopped out on, and this was a real frustration with us. CARG Gurus, we actually at one point, and this is where we could really improve our trading technique here at the TMC, and we're working on it. At one point, I believe we were up almost 14% on CARG Gurus. I believe we covered this last week, and ended up, we didn't take much of a loss, really. Actually, we didn't take any of a loss. We bought it. No, we did. We bought it a few cents. Bought it at 32.08, sold it at 32.07. Not enough to speak of. But at one point, we were up pretty good on CARG Gurus, and it just absolutely tanked. We're still watching CARG Gurus. We'll see how life works out as we go. CMC, commercial metals, were actually up 4%. This is one of the few success stories we actually have at the moment where the stock is moving up. So CMC, we're very pleased with what we have going on here. I think we even moved our stop up to 95. Expeditors, EXPD, Expeditors International, we're still watching. They're a little elevated for our taste up here and are showing weakness that they'll return to this level here. So EXPD is still watching it. FCX, Freeport McMoran, this was one of the major disappointments of this week. We took a position in FCX about halfway up this move, and the very next day the stock gapped down and stopped us out. Such is life in the single stock world, and that was part of what led us here at the TMC to take what I will show you is one of our positions that is a somewhat of a deviation from what we've been doing. So we just immediately took a 6.5% loss on that, and that was very unexpected. We thought that we had done a good thing. Of course, we don't do anything we don't think is a good thing. 4D Molecular, we were stopped out on about a week ago at 9.05. It's at 9.15, kind of waiting for a turn here. What we do with that here is we go a month and 1 day. That's a regression line we've overlaid. We're really not seeing the turn yet. So we will, FDMT, we'll keep up with. We sold Fox at 59.45 because it looked like it right after these earnings, it just took a real spike up this way. We had bought it at 53 all the way back here in February. And 53 to 59.45, we thought, with the market doing what it's doing right now, you know what? We just need to take it. And we did. And it's so far been a good thing that we did. So still watching it. Could be that what we end up seeing is just a simple return to this sort of line here. We will follow, return, and report. We have to follow FUBO. FUBO is still what Dave Keller would refer to as a bad chart. It simply can't get out of its own way. This was earnings, went down. Our favorite person, Creative Ostrich 4066, told us many times right here that FUBO was on the move, and yes it was, and now it's on the move again, down, and so we just cannot find any footing with FUBO, and we don't own any. We tried it once, got stopped out here at the 12s, and just simply have not returned to it again. July Satellite, we actually bought GILT. Right down here you can see how each of these is a higher low. For the moment we're down 4.6%, but our stop is here at 1474. So far we're okay. If we just simply get stopped out come Monday, who knows? But for now, we have higher lows, and higher highs, and so we bought into GILT, Gillette Satellite. Looked like the thing to do. HCSG, we're still waiting for some sort of return. We did very well. We took on a lot of risk, probably many would consider excess risk, by buying HCSG and holding it. At the time we went into earnings with HCSG, the truth was the market didn't feel as negative or as dragged down as it does now. But we are watching HCSG for a turn. KRMN, we have not bought back into. We are watching this formation down here. Their earnings were actually quite good. They just, with the exception of the fact that we know that with an oil price spike and tariffs and all of the things that are going on, the cost of capital will go up. And so companies that have to use debt and have shakier and lumpier revenues and earnings should go down because of market concern. KRMN is still a very solid company, but we're subject to the technicals of the market, and so what we're doing is we're waiting for KRMN's return to some sort of trend right there. Lemonade we got stopped out of about a week ago, and we've drawn a line. We're waiting for Lemonade to turn, but the Lemonade appears to be a very good company, but again, we have to do what Lemonade tells us. ROST and TJ Maxx, ROST and TJX. There's ROST, 6 months of it, where we got stopped out. There's TJX, where we voluntarily sold it because it was going the wrong direction. TJX's earnings are coming up on May the 20th. That is this week. Who knows what could happen? At the moment, earnings, even good earnings, are sending a lot of stocks down. So we don't know. TJX is a fantastic company that holds a very powerful spot in the retail infrastructure, but we'll see what happens with TJX. We're not going to buy it going into earnings here. Service Corp we're paying attention to because it looks like it has SCI, looks like it has a turn down in this area, and this is a higher low than that low right there. This is a higher high than that high. It's lumpy, but Service Corp actually looks like one that we may be interested in. So we've drawn this line, we're paying attention to it. We'll see what happens. May take a position in Service Corp at some point over the next couple of weeks. SOFI, once again, we got stopped out of SOFI. Now I need to explain that stop out. If we show a year of SOFI, all the way back over here at the very, very top, headed up, we got stopped out of SOFI twice. So we're a little bit skittish on SOFI. After SOFI did this whole thing and went down and then started establishing a trend down this way, SOFI is a great looking company on paper. It just is. The fundamentals give you every reason to believe that SOFI is a company that's going to do well in the future. It's the technicals that are concerning. And again, we're subject to the market price. So we took a position in SOFI, but we put a very, very narrow stop on it. So we didn't lose a whole lot on getting stopped out on SOFI right there. We may buy back into SOFI if we can just see our way clear. It was one of those things that unless we just nailed the entry, we simply weren't interested in holding SOFI any longer than that. We may regret that in a few years. I don't know. But we, for right now, are out of SOFI because we just didn't nail the entry. But it would have had to have really been nailed. TJX we talked about. We have to talk about TMC, the metals company, only because people come around here to the 10 mil club asking about TMC, the metals company. An interesting development with TMC. This is not something that we would otherwise normally follow. You can see the 6 month downtrend on TMC, the metals company, but it did cross the line here. The thing about TMC, the metals company, this was an interesting bit of news right here. Right here, they purchased that one right there. If you're on May the 6th, TMC, the metals company, purchased a royalty interest in an iron mining operation in Minnesota. I'm going to, in the Mesabi range, I'm going to be honest with you, I have followed the Mesabi range for a long time and everything, but I did not think that TMC, the metals company, was into the iron business. I thought that they were into critical minerals and rare earth metals and pulling them off of the ocean floor about 1,800 miles southwest of San Diego in the Pacific Ocean. I did not think that they were into royalties for iron mines in the Mesabi range. Market barely reacted to that news at all. May 6th, I mean it did, but it kind of came right back to the averages. That day, I suppose, stock closed up quite a bit, but you just never know about TMC, the metals company. Again, it's almost impossible to value those shares. It's just the way it is. We got stopped out on Vera Bradley, VRA. It just simply took a dive. And so what we're doing now is watching this line that touches these lows for Vera Bradley to see if maybe Vera Bradley will give us some sort of turn and tell us to buy back in. But for the moment, we're out of Vera Bradley. My brother owns a lot of Walmart, WMT. Walmart is down $1.01 from on Friday, which, by the way, was option expiration day and felt a little bit weird, and I'm going to touch on that here in just a minute. But Walmart just maintains its uptrend, and that would make sense because in a recession, which we may be about to enter, Walmart is the perfect stock because people trade down and start using Walmart. Let me talk about that just for a minute. If we're not in a recession right now, the NBER declares when we were in a recession, and they're really good at telling you when we were in a recession, but they can't tell you when you're in a recession in the moment. They're very, very poor at that. Every time we've had a major oil shock, like a major oil shock, it seems like we end up in a recession very quickly after that. Sometimes as much as a year later. Sometimes we're actually already in one by the time the oil shock happens. And right now we have a very significant oil shock that's just happened, and it could be that the market actually hasn't reacted to that fully yet. And all these stop outs and things that we have experienced here at the TMC is beginning to make us feel like we really need to start preparing for the very real possibility that all of the news turns negative and starts telling us about a recession that's on, one that we've actually been waiting for several years. It just hasn't really happened. Touching on YETI real quick, we do still follow YETI, and it does have an uptrend. But it does also has a 6-month downtrend, so we'd have to be very careful. We would need to nail the entry on YETI. Real quick, because of the fact that we've gotten stopped out of so many things here at TMC on things that we thought were pretty good entries, we shifted gears this week. And here's what we did. We put some thinking together. This is SOXX, which follows the semiconductor index. SOX, I believe, is the semiconductor index. SOXX is an ETF that is intended to track. Now, it does not perfectly track the semiconductor index, but it does track the semiconductor index to an extent. How it's rebalanced, when it's rebalanced, those are all details that we actually haven't had the time to get totally into here at the TMC. We just simply pulled up a set of them, and our thinking was this. With breadth laying off on the market and us getting stopped out of a lot of things under the surface, what we thought was, okay, there's a lot of money that has to go somewhere, and where does that money have to go? Well, it's going to go probably toward the tech and AI build out. And what's at the center of that tech and AI build out? The semiconductor world. You can see the striking run up in the semiconductor index starting back at the end of March and running all the way up to now. But here's the thing. A market can run a lot further than you think it really should. And there are plenty of articles written out there about how it seems like semiconductors and the semiconductor index, semiconductor stocks in general, are in some sort of a bubble. I'm not going to deny that. Okay? We talked about that here at the TMC among ourselves this week. But what we did was we simply decided to buy into SOXX at this level right here, 522.44. Now we're down just a little bit, and the concern is this. 1 month, 1 hour. On Friday, which, like I said, was options expiration day. And from a technical standpoint, that may mean something. So we didn't really panic, but we did keep an eye on SOXX very closely because we bought it right there at 522.44, and then we're down just a little, then we're up just a little, and then we're back down just a little. This piercing of the trend line does not feel good, and so we have our stop in place, but we're not really that near it at the moment. Now, one day we could easily get stopped out right there on that one day. But that was our thinking was, okay, now this is of concern. That high is not higher than that high, but that high is awful high. It is higher than that high, but it's not higher than that high. So that's what we did. We went with SOXX, and the thinking was just, okay, well, all that money has to go somewhere. Now, the counterpoint to that is this. The bond market is seeing a rise in long duration bonds and in the 2-year bond. Long duration bonds, a rise in the yield for long duration bonds and the yield for 2-year bonds. The 10-year really isn't moving all that much, up a little, but not a whole lot. The 30-year bond, the 25-year out there in the long durations, the thinking there is those are more indicative of long-term inflation expectations and growth expectations from the economy. If growth is not going to be as good as we thought it was, if inflation is going to be worse than we thought it was, we need to be compensated for both of those things at a better rate, and so bonds get sold off, yield rates go up. And they have been out there. The 2-year is different. The 2-year is more indicative of what the market thinks short-term interest rate policy from the Fed will likely be, because anything shorter than 2 years is kind of laden with a whole bunch of noise that the Federal Reserve actually moves the effective federal funds rate, and SOFR is down there, and there's a whole bunch of really short, the repo market is down that way, and so shorter than 2 years is laden with a lot of noise. But the 2-year is watched specifically because the thinking is that the 2-year will be more indicative of Fed policy. That's been rising in as well, and it's because we're about to get a new chair of the Federal Reserve, and the thinking is that with oil prices higher and inflation running hotter than the Fed's 2% target, we're more likely to see the Fed raise rates than cut them. And let's be honest, the previous Fed structure that we've had up until now has been a bit more accommodative than many think they should have been. Apolitical here, we don't do anything other than try to make money. But some of the thinking has been that Fed has been a bit too accommodative for too long. The incoming Fed chair is known to dislike a large Fed balance sheet, and so allowing a lot of those assets to expire or even selling some of them would raise the yield curve, and those have durations all along the yield curve, which could a wide scale selling of them, or at least just once again quantitative tightening, just simply allowing those assets to expire and not replacing them on the balance sheet would probably raise the entire yield curve all the way across, because essentially after the great financial crisis, the Fed kind of took control of the entire yield curve for the first time in our nation's history, I believe. So the headwind is that semiconductor companies and the tech companies that use semiconductors, that buy them, are very debt-heavy companies with the two ends of the yield curve rising, showing less confidence in long-term growth, more of a concern with long-term inflation, and on the short end of the yield curve, more of a concern with rising interest rates, which will affect corporate lending rates. That would be a headwind to the semiconductor ETF and the semiconductor industry. We'll see. We bought it because we figured, money's got to go somewhere, and we know it's extended, and it is. It's this ETF, so let's give you 6 months of it. This is the 50-day moving average for that ETF. That, if we're to calculate that, 508.52 divided by 401.05 minus 1, that is extended 26.8% above its 50-day moving average. That is pretty far. That's more than 25%, which is kind of an alarm level. Now, my understanding is SOXX itself is actually extended much further than that. That's right now it's 11,588. Just run it real quick. 11,588 divided by 91.94. No, 26%. So, okay, so SOXX is actually tracking SOXX about as good as I would have expected. Final point that we would like to make today, we started this week kind of pivoting. Like I said, the reason we picked SOXX, we don't pick a lot of ETFs here, but our thinking was those semiconductor stocks are so volatile that it's actually going to be really hard for us to nail an entry on a semiconductor stock. And so we decided to buy that ETF in order to simply remove idiosyncratic or unsystematic risk from the equation as much as we possibly could. SOXX has 31 holdings. That's just enough to basically diversify away most of the idiosyncratic or unsystematic risk. And so what we did, we elected to mitigate our security-specific risk by buying that as opposed to any actual market leaders or anything in that area, so we would know whether or not we really needed to get out of that sector. And that's what we did. But we started researching some things this week here that the reason is this. So we actually thought the S&P 500 ETF that we prefer to follow is SPYM. There are several. I believe SPY is one, VOO is another one. So what we did, the SPYM is what we watch, and you can see the S&P 500's a meteoric rise, I suppose, if you want to call it that. And it kind of depends on how you draw this line. We're kind of waiting for a breakdown in the S&P 500. We figure that one has to be coming because, again, it closed at 86.99. Divided by 81.19. Now that is only 7% over its 50-day moving average. So that's not super duper extended, but we do know that the market is way overvalued for as far as historic measures are concerned. This week I actually watched a video. There were two people, and I'm very, very sorry I don't remember their names, but the CMT Association, which I have a lot of respect for, put on a video presentation with two people whose names I really should know, but they were fascinating earlier this week. And the first speaker talked about how currently the S&P 500 is sitting at 2 standard deviations above the mean for its price to forward earnings, and that historically at those levels the returns going forward have not been very good past that point. I believe it. That doesn't mean that the market can't keep going up. It absolutely can. But the S&P 500, if you look at it right here, it's just, we're waiting for some sort of breakdown. And the truth is, it can happen very, very quickly. So, a couple of things that we've started watching. We've started watching SH. So SH is actually the ProShares short S&P 500 ETF. And we don't know precisely when that's going to turn. I mean, look, we can put lines in here all day, but when the sell-off comes, we want to be ready, and so we're starting to watch SH. Another one we started watching this week was PSQ. PSQ is the short QQQ, which is the NASDAQ, which is tech heavy. So we started watching that one. You can see, of course, it's inverse. So with the NASDAQ's rise, you know, here's QQQ. So QQQ, of course, has this, you know, stratospheric rise with all of the tech and everything. But here's the tiny little break, which kind of mirrors SOXX. PSQ is the short version. We started watching that as well. And one last thing we started watching, TBF, is actually the ProShares short 20-plus year Treasury ETF. So with Treasuries beginning to sell off on the long end, if we end up with lower, I mean, you can see a serious tick up here. As far as one-time unlevered inverse bond ETFs are concerned, a jump from 24.69 to 25.11 is actually a pretty nice jump. We started watching this in case there was any kind of complete breakdown in the bond market, because if we get a return and then a breakdown, we might actually have the opportunity to make some good money off of the bond market, though it's tougher. That's why there are a lot of 2 and 3 times ETFs in the bond market. And that is the way we see it. From all of us here at the 10 Mil Club Production Room, we thank you for being with us. Laura Sue, Will, Mark Thomas in Production and Engineering, Sophie, Hannah, and Presley as the 10 Mil Club Singers, and Jackson as our announcer. We will see you next time on the
10